Far from being just imaginary animals, unicorns are a natural topic in current business and investment discussions. We often talk about unicorns like Uber, Airbnb and the likes, but little do we discuss what does unicorn exactly mean. Ever wondered why some startups are given this title? What are the criteria to get this title? Or have you just wondered whether investing in unicorn companies is the right thing to do? This episode will answer all of these questions and also walk you through the pros and cons of investing in unicorn companies. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos on the most performing unicorn to add to your investing portfolio. What is a unicorn startup company? In finance, unicorn is a term that describes a privately owned startup with a valuation of over $1 billion. The term was introduced by venture capital investor Eileen Lee in 2013 to describe rare tech startups that were valued at more than $1 billion. The phenomenon of unicorns is quite controversial. Although some professionals believe that such companies are just the result of technological progress and innovation, others believe that the increasing number of unicorns is a sign of a bubble in the industry. Valuation of unicorns. The valuation of unicorns is derived from valuations developed by venture capitalists and investors who participated in the financing rounds of the companies. Since all unicorns are startups, their value is primarily based on their growth potential and expected development. The value of a unicorn company is usually calculated based on its most recent round of funding. If a venture capitalist puts $100 million into a business in exchange for 5% equity, for example, they valued it at $2 billion. Alternatively, sometimes unicorns are priced when they're acquired by someone bigger, for example when Facebook bought Instagram for $1 billion. It's worth noting that the quoted size of a unicorn tends to be a post-money valuation. That means it takes any recent investment into account. But how do investors determine the value of a new business? Unlike with established companies, they'll usually take a long-term view and focus solely on future potential. Unicorn investment is rarely tied to the profit a venture is making now. It's all about what they can do years down the line. Occasionally, that approach can backfire. SoftBank, a leading investor in WeWork, took an early $4.6 billion hit when the company failed to float in 2019. Examples of unicorn companies. Some unicorn companies that you may have heard of include 1. Airbnb. Airbnb is an online platform where members can advertise their living spaces as short-term lodging. For many years, Airbnb and Uber were the poster child sharing economy unicorns. But while Uber opted to list in 2019, Airbnb held fire. The business had announced plans for an IPO at some point in 2020. Unlike many unicorns, Airbnb is actually a profitable business. The company made $93 million in 2017. It's also relatively old, hitting a valuation of $1 billion all the way back in 2011. 2. SpaceX. SpaceX has a lofty goal to reduce the cost of space travel and eventually enable the colonization of Mars. It's made significant strides towards that ambition since its launch in 2002, including successfully reusing an orbital rocket in 2017. The company planned on launching the first crewed mission for its Dragon 2 craft in May 2020. Space travel isn't cheap, so perhaps unsurprisingly, SpaceX is heavily dependent on outside capital, raising over $1 billion in 2019 alone. The company does make money too though, mostly from a contract with NASA. 3. Stripe. The biggest unlisted startup in the US is currently Stripe, which makes software that enables businesses to make and receive payments online. Patrick and John Collison founded Stripe in 2009, and the company was worth $100 million by the time of its Series A investment in 2012. It joined the unicorn list in 2014, and by 2016 was valued at $9 billion. Peter Thiel, the entrepreneur and co-founder of PayPal, was an early investor. The company was described as ripe for an IPO in 2020. 4. Didi Chuxing. Didi Chuxing, known by its users as Didi, provides a variety of transport options via its app. These options include Uber-style taxis, private cars and shared rides, as well as bike sharing, vehicle rentals and more. The company is the leading private transport in China, with 550 million users and millions of drivers as of 2018. In 2016, it acquired its biggest rival, Uber China. It was rumored to be planning an IPO in 2019, but didn't end up following US competitors Lyft and Uber by floating. 5. ByteDance. ByteDance is a Chinese software company. It was founded in 2012 by Yang Yiming and is best known for its content platform Toutiao, or Headlines in English, and social media app TikTok. Toutiao shows personalized news and information feed to its users using machine learning to tailor content to each reader's personal preferences. TikTok enables users to create and share short music or looping videos. TikTok hit 1 billion downloads in 2019. ByteDance's value comes from a $3 billion investment in October 2018 led by SoftBank. Pros and cons of unicorn companies. Before investing in a unicorn, consider these 5 pros and 4 cons. Pros. 1. Returns. Backing a successful startup can provide supercharged return for investors who get in early, buy shares when they're a few cents, and exit a year or two after the company's initial public offering on a stock exchange. 2. Excitement. Backing a tiny unlisted venture that develops into a larger ASX-listed company can provide much personal satisfaction. For some investors, backing early-stage ventures is also about supporting Australian innovation and investing in entrepreneurship. 3. Tax incentives. The government provides a range of tax incentives to encourage investment in early-stage ventures. The venture needs to qualify as an early-stage innovation company, and investors need to meet the sophisticated investor test under the Corporations Act to avoid certain restrictions. 4. Professional managers. Sophisticated investors who back unlisted companies through venture capital funds benefit from expert managers who live and breathe this space. That's no guarantee of success, but identifying, assessing, valuing, and monitoring emerging ventures takes great skill. 5. Diversification. Investing in private equity through listed investment companies or unit trusts aids diversification in 2 ways. First, the fund could invest directly in a large number of companies or in other funds that invest in private equity in Australia or overseas. Second, private equity as an asset class has lower correlation with listed equities. Rises or falls in the Australian share market have far less effect on unlisted companies, helping portfolio diversification. Cons. As with anything, investing in unicorns has its disadvantages, some of which include 1. Risk. Early-stage ventures have high risk. It's thought that up to 4 of every 10 companies backed by venture capital fail, 4 return their original investment, and only 1 or 2 deliver big returns. This is no place for inexperienced, conservative, or risk-averse investors, or those who cannot recover from capital loss or have a short-term outlook. 2. Hype. Every good startup has a compelling story or an advisor who helps pitch it as the next big thing. Platforms connecting startups and investors sometimes feature low-quality companies that are desperate for capital and will take funds from wherever they can get them. The best emerging ventures are usually well supported by professional investors and wealthy families. 3. Liquidity. Early investors in startups often learn a painful lesson about share liquidity. When they need to sell, they can't because there are no buyers. They might have to wait for infrequent liquidity events where the shares can be traded, or years for a merger or IPO to get their money out. 4. Majority control. An investor who has a small stake in a startup can be at the mercy of the founder who has majority control. There may be no board to protect shareholder interests, and the founder's interests might be poorly aligned with those of small investors. Should you invest in unicorn companies? 2013 was a simpler time to invest in unicorns. There were only 39 private startups valued at $1 billion or more, 37 of them were based in the US, and the collective value was around $150 billion, excluding Facebook, which accounted for nearly half the total. How things have changed. In Q4 2019, there were over 500 unicorns spanning 24 countries and collectively valued at over $2 trillion. Dozens of unicorns joined the list each month. But a unicorn boom is not necessarily a unicorn bubble. Given low interest rates, continued growth in technology, and recent regulatory perks, investing in unicorn makes sense. Late-stage startups can still obtain capital despite billion-dollar valuations, so why go public? And investors can achieve ROI from unicorns that they won't find anywhere else. However, investing in unicorns comes with a paradox. The availability of private equity makes them less likely to go public, but their reticence towards public markets make their stock hard to find. Today's unicorns are no longer as rare as their mythical counterparts, but they can be just as hard to approach. How to invest in unicorn companies. To invest in unicorn companies, you'll have to wait until the company is ready to go public. Once the company is public, you can then invest like other stocks. Other ways to invest in unicorn companies are You could invest in the startup of a friend or family as a seed investor. You could pool in some of your friends and look for opportunities as an angel investor. Once you've matured out of steps 1 and 2, you could participate in funding rounds of a venture capital fund and invest capital there. Consider investing in a mutual fund or ETF that focuses its fund on private companies. That could give you exposure to the unicorn market without the wealth to get direct access. If you're thinking about adding a unicorn company to your portfolio after they go public, make sure you do your due diligence. There are tools to help you narrow down the choices of companies that meet your requirements. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.